Talking to David Wright, Deputy Director General of DG Internal Market and Services. We're talking about the financial crisis and the regulatory changes that are hopefully underway. I saw you at an event a few days ago and you were saying some interesting things relating to whether we fix this financial crisis and what goes on. And you were trying to answer what happens if there's a second crisis, if things move from here. What were your thoughts?
Well, we have to, at all costs, avoid a second crisis. I mean, this crisis has resulted in European GDP being down 6% against trend last year. We've got unemployment going up. We've got government debt estimated to be going up between 20, 30, 40% over the next few years. We cannot afford another crisis. So we are now in the space of deep regulatory repair to avoid that happening.
Now, if something like this happens again, heaven forbid, that's the last thing we want, but if it were to happen, is Europe able to wind up a large investment bank?
Well, that is what we have to do in the future, and my Commissioner Barnier, has made it very clear that he wants to put in place as one of his top priorities a crisis management system that will allow us to do that. Now, if we can't do that, if we're going to say that we can't wind up, stabilize, resolve, wind up a big institution, this obviously has knock-on effects both on regulation, on supervision, and maybe even architecture. So this is right at the center of financial reform, as it is in the United States. It's a crucial question. And we're now working very hard on looking at a comprehensive set of amendments, rules, which will span the prevention. So you want higher capital in the system, early intervention by the supervisors to stabilize institutions in trouble, then your resolution regime, and then your winding up regime. It's all got to work, all four parts of it. And we're working on that now. And in fact, the Commission, towards the end of this month, beginning of next month, is going to look very closely at whether we should start to build ex-ante resolution funds. That's another issue which is part of this package, which Commissioner Barnier calls Fonds de Prévoyance, and we're working hard on that right now.
Now, I mean, the situation as it occurred back in 2008 with Lehman Brothers, as the obvious example of this, when the American government was trying to wind it up, they opened the derivatives market for something like 3 hours on a Sunday to unwind some trades, and then there was a period of maybe 8 or 9 days where hundreds of billions were wiped off the face of markets worldwide because of the interconnectivity of the trades they were involved in, the derivatives contracts, and their own business models. It's complicated stuff. What's it going to take to make this real?
Real in the sense that you can stabilize a complex institution. You're going to have a series of powers and policies given to supervisors to be able to stabilize a situation of that type. Now, the United States didn't have that, and now they're amending their own resolution regime. They're going to give new powers to the FDIC, with or without funds. We're not sure about that yet. That's being discussed. But they're going to have the powers to stabilize, resolve, and indeed wind up these big institutions. And in Europe, we're going to have the same. Now, the question is, what is the elements of that policy? And we're working on that now. And it's complex. Some people are talking about looking at contingent capital, whereby capital that was issued in the form of bonds could be changed into equity in a crisis situation. That's one tool. And there are others. We're looking at that now. There's no silver bullet here. It's going to be a suite of policies, powers for supervisors to be able to act decisively in these types of situations. When you have very little time, you don't have the luxury of months. No, you have the luxury, maybe, if you're lucky, of the weekend.
Yeah. Absolutely true. Now, something that's being used a lot in the conversations relating to this package at the moment is the phrase regulatory arbitrage. Brand new to almost everybody in society, I'm sure, something that didn't exist, or at least the concept didn't exist only a year ago. Would you perhaps give us a layman's description of what this really means?
Well, let's take an example to make the point. Let us assume that the United States introduces rules on OTC derivatives. Mm-hmm. And let us assume we do the same. Mm-hmm. But our rules, let us say, are tougher than the US rules, or vice versa. What that means is that the business will shift to where the rules are less tough.
Sure.
Now, what you really want, and that is the big challenge for both the United States and ourselves, particularly in this area of OTC derivatives, is that we come up with rules that are very, very equivalent, as close as you can get. You've got different legal systems, but the substance of the rules must be the same. A dealer in New York must be able to be subject to the same set of rules and disciplines as somebody doing the same type of business in London, Paris, or Frankfurt. And if we don't have that global coordination, we're just going to have holes in the regulatory system, and capital and business will flow to where the rules are weakest. We know that. So this is why the G20 process is so critical, to get to a high level of standards as equivalent as possible. And these are some of the themes that I'm sure Commissioner Barnier is going to raise when he visits the United States next week.
Now, personally, I have a background in finance, and I've had the pleasure or dubious honour, however you might want to describe it, of meeting perhaps half a dozen hedge fund managers in my previous career. Something that struck me, meeting each of them, was they were very proud of the fact that they were able to avoid the legislation. They deliberately used different parts of the world for different elements of their business model. They're using small islands in the Caribbean, in the Channel Islands, they're using London and New York and goodness knows what else. Is there any way really that regulatory arbitrage can be avoided? Do you think you can genuinely stop this kind of thing from happening?
Well, I mean, you've just described regulatory arbitrage in a very good way, and that's exactly what we do want to happen. What we're trying to do here is very simple. The G20, the world's leaders, have said that we must have appropriate regulation of hedge funds. And we're trying to do that. What does that mean? It means more transparency, more understanding of what's going on, knowledge about the leverage levels. We need to be sure that the assets are being held in safe places and with safe institutions. So all those sorts of things, sensible things that ordinary supervisors must know. That's what we're trying to build here. We want to make sure that when people do business in Europe, with clients in Europe, that those clients are dealing with bona fide, good regulated hedge fund managers, or indeed hedge funds in different jurisdictions. And so again, what we're trying to do is raise standards here. We're not trying to stop the business. We want to see the business do well, but it's got to be subject to high standards. And we want those high standards not just in Europe, but in third countries as well. So in our original proposal in the Commission, we said those funds and those managers can do business in Europe, provided they apply the same standards as we do. Otherwise, we're just going to have a vessel which has just got holes in it. And that's not acceptable. And what you're seeing now at the global level, in the G20 as well, is a genuine effort to try to raise standards in what we call non-cooperative jurisdictions. Throughout the world, we want higher standards, the standards of Basel, the standards of IOSCO on the security side, the standards on the insurance side from the IAIS, high-level accounting standards. We want the world to apply high-level standards. And if they don't, then they're not going to have unfair access to our markets. That is true, I think, from the US perspective, as it is true from the European perspective. So this is all about raising standards, raising understanding of what's going on in financial markets. We can't have a supervisory and regulatory system that doesn't understand what is going on. We want transparency in the markets. We need people to understand what is going on. In that case, we're going to have a safer system. And I come back to what I said at the beginning. If we don't have a safer system, if we have these really very severe economic costs, people just won't put up with it. So either we reform, and we reform strongly, sensibly, we calibrate the work properly, proper impact analysis, sequencing, accumulation, all those effects calculated, that's what we're doing. But if we don't do that job properly, we're going to build up trouble for another crisis. And another crisis could be even severer, and that could have even more serious effects on our society and ordinary people. And that is what we're trying desperately hard to avoid. And I believe we're beginning to have some success here.
It's interesting.